Hey everyone, and welcome back to The Explainer. Today we are diving straight into a really fascinating analysis of question 2 from our source material, which tackles the high-stakes world of tax-efficient business structures. It's honestly an incredible look at how just understanding the rules of the game can completely transform a company's bottom line. Let's get right into it.
So, I want to start off with a pretty big question. Could a single paperwork decision actually save you over 11 million rupees? Now, I know that sounds a bit like an exaggeration, but I assure you it is not a hypothetical number. That is the actual, tangible cash difference we are going to uncover today. It's literally the difference between a business carrying unnecessary heavy dead weight and a business that is fully primed for growth. You know, we so often think the main way to increase our margins is to just hustle harder and scale operations. But as you'll see in this case study, sometimes the absolute biggest financial gains come simply from how you architect your foundation right from day one.
Okay, so let's meet the entrepreneur at the center of our story today, Rashid Hussain. Rashid has a cool 100 million rupees in capital to play with, but with no external financing available, every single rupee he has needs to be deployed with absolute precision. He's planning to launch 2 very distinct businesses. First up, a consumer products manufacturing facility, which is going to take up the bulk of his capital at 75 million rupees. And second, a local corporate training service, which will use the remaining 25 million rupees. It's a really solid, well-diversified strategy. But before operations even begin, he faces a massive structural choice.
Let's look at the financial reality Rashid is projecting for his very first year. For manufacturing, he's projecting 150 million rupees in local revenue plus another 60 million in exports. Meanwhile, his training service is projected to bring in another 70 million in revenue. I mean, these are incredibly healthy margins, showing really solid taxable income across the board. But this brings us to a classic fork in the road for any business owner. Does he consolidate all of this revenue and activity into one single company, or does he split them up? Let's explore that first path.
All right, option 1, the single company approach. On the surface, this seems like the most straightforward route. You have one board of directors, one central bank account, one single tax return to file. You just bring the manufacturing plant and the training service under one big unified corporate roof. It definitely sounds super efficient administratively. But here's the catch. What is easy for the administrator can be absolutely brutal for the accountant.
Let's actually work through the math here. When everything is lumped together, standard corporate tax rates apply aggressively. His local manufacturing sales fall under the normal tax regime, or NTR, which sits at a steep 29%. That immediately eats up 9.86 million rupees. Then, looking at his exports under the minimum tax regime, we have to compare 29% of taxable income against 1% of total export revenue, and you end up paying the higher amount. Well, the 29% rate wins that battle, costing him another 2.32 million. Finally, the service income under the MTR triggers a 4.2 million rupee liability based on a flat 6% of that 70 million revenue.
You add all of those up and, ouch, 16.38 million rupees. That is Rashid's total tax liability for his first year if he uses a single company. I mean, to put that into perspective, that is nearly 16.5% of his entire initial startup capital, just gone in year 1. The source material notes this is vastly higher than the baseline minimum tax threshold of 3.5 million for a company of this size. That 29% normal tax rate basically just indiscriminately punishes his diverse revenue streams. There absolutely has to be a more efficient approach. And thankfully, there is. That brings us to option 2, the separate entities approach. Instead of combining his 100 million capital, Rashid splits it right down the middle of his 2 ideas. He uses 75 million to form a dedicated manufacturing company and 25 million to form a completely separate corporate training services company. Now sure, while it requires a little bit more paperwork up front, separating these entities unlocks highly targeted tax benefits that are completely inaccessible when the 2 businesses are just mixed together. To understand exactly why this works, we need to demystify a couple of tax acronyms, SME and FTR. Because Rashid's manufacturing turnover is projected at 210 million, which is comfortably below the 250 million threshold, that manufacturing company officially qualifies as a small and medium enterprise, or SME. This is absolutely crucial because it gives him the power to actually choose his tax regime, and one of those choices is the final tax regime, or FTR. Under FTR, you just pay a flat percentage on your total turnover. It serves as the final word on your tax bill, totally sidestepping all those complex deductions and that brutal 29% standard rate. This separation is a real game changer because it fundamentally changes the businesses in the eyes of the tax code.
The manufacturing entity stands on its own, unlocking that critical SME status. Simultaneously, because the corporate training entity's capital requirement is only 25 million rupees, which is well under the 50 million limit, it unlocks official small company status. By simply drawing a structural line between the two businesses on paper, Rashid has fundamentally rewritten the rules he has to play by.
Let's look at the incredible leverage that SME status provides for manufacturing. Rashid has a really important micro-decision to make here. He can choose the normal tax regime, calculating a reduced 15% rate on local sales and 0.5% on exports, which yields a 5.4 million tax bill. Now, that's already a huge improvement, right? But if he opts for the final tax regime, his entire turnover is taxed at a flat 0.5%. That brings his manufacturing tax liability down to an astonishing 1.05 million rupees. And the best part, he can lock this in for 3 whole years without any minimum tax applying.
Okay, so what about the corporate training services company? Well, holding small company status means its tax is calculated under the minimum tax regime. The rules dictate taking the higher of the normal corporate tax, which is calculated at 2.4 million, or the minimum tax based on total revenue, which is 4.2 million. The tax authority naturally takes the higher number, setting the services company liability at 4.2 million rupees. But you know what? Even taking the higher hit here, the overall trajectory of his finances is entirely different from that single company path. When we put these two paths side by side, the contrast is absolutely wild. The single company yields a massive 16.38 million rupee tax liability. But by setting up separate entities, adding the 1.05 million from manufacturing to the 4.2 million from services, his combined tax bill is just 5.25 million rupees. That is 11.13 million rupees retained in year 1 alone. That's cash he keeps to reinvest, hire more people, or just build his safety net. The analysis of question 2 from our source material really sums it up perfectly. Using 2 separate companies is more tax efficient for Rashid Hussain than operating through a single company. It's a very simple conclusion, but man, it carries an 11 million rupee weight. It shows us that how you structure your business can literally be just as critical as your sales. Rashid didn't have to invent a new product or magically find new customers to realize those savings. He just had to understand the terrain and set up his corporate boundaries intelligently.
Which leaves us with this final thought. If a structural choice at the starting line can unlock over 11 million rupees in retained capital, what hidden inefficiencies are waiting in your own business plans? Whether you are dealing with 100 million rupees or 100,000, the principle remains exactly the same. Structure dictates efficiency. So don't just build a business, architect it. Thanks for tuning into this explainer, and we will catch you in the next one.